The market is looking fairly strong today after the inflation report, but if we take a look at it over the last few weeks, it is still down in the red, and today we've done a quick screener for companies that are near their 52-week lows to see whether or not these are some strong buys, or in fact maybe these are ones we should avoid. Now the first one we're looking at today is Estee Lauder. This one has been absolutely battered, down 43% over the last year, and if you've been a longer shareholder over the last 10 years, you would be pretty much at the same point than you were 10 years ago, although we do in fact notice all-time highs did sit around $370, right now trading right there towards their 52-week lows. We actually get a strong sell rating from Quant, a hold from Seeking Alpha as well as Wall Street, and they do currently pay a dividend around the 1.9% mark. If we look at their earnings, not looking particularly great. Over the next 4 quarters, they're expecting 3 of them to be double-digit decrease year on year. Positive to say though, over the last 4 quarters, they have outperformed on every single one, and if we look to June 2026, their next full accounting period, their forward P will come down to something a little bit more reasonable around the 27 mark. In terms of the valuation, well, they do get an F grade. No surprises when you do compare them to the sector median. They are trading at a very large premium, in fact 196%, and this is something that is reinforced no matter which metric you do take a look at. They are very, very expensive. In fact, some companies actually deserve a premium. Question is, does Estee Lauder deserve it? And you'd probably get an answer of no, given their growth is at an F. Year on year, pretty much flat with the sector median, not much but still 1.6%. Moving forwards, they're anticipating negative 1%. The sector again positive but still fairly minimal at 2%. And one thing we do quite like for this company is their earnings per share at around 10.4% anticipated over the next 3 to 5 years, which does come in marginally higher than the sector comparative at 7.4%. Now, in terms of their profitability, they do get a B+. Gross margin actually looking very, very strong, 72 versus the sector comparative of 36. Bottom line though, very, very poor. Given how high their gross margin is, we can in fact see their operating costs must be very high, and it's also lower than the sector comparative at 4.2. The one good thing though is their cash from operations. They do generate a lot, 2.1 billion, significantly higher than the 877 million from the sector. Now, we do want to make you aware their dividend score does come in at a 40 unsafe, and this is after they already had a dividend cut in October of around 47%. The reason why it does get this unsafe score, whilst we won't go into all of the metrics, we just want to point out, based on the net debt to EBITDA, which does correlate to dividend safety, balance sheet strength, is in fact increasing over the last few years. Now remember, the numbers you do see below are the number of years it would take the company to pay off all of their debt net of cash on hand, and whilst we do want to see a maximum of 3, it is below that. However, the trend from 2022 is in the wrong direction. Typically with companies, we see them actually decrease over the next 12 months, anticipated to go higher. That for us is a red flag indicator alongside that dividend safety score of 40. Typically on this channel, we do our deep dives. We do run through the models that we do use, talk about the inputs and outputs. Today, getting straight to it, we're essentially saying right now, Estee Lauder trading at a value of $75 is essentially where we see this intrinsic value, essentially saying there is no margin of safety and there is no current premium on the value. Now, Wall Street, they see 7% upside, very minimal over the next 12 months, trading around $80 at the end of 2025. But for those that do want to know, in terms of a 10% MOS, which is where we typically start off with, we execute on these stocks if they meet our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, for Estee Lauder, that would be around $68. For those that want to see at 15%, around $64, and at 20, around $60. But right now, as of today's date, we see no margin of safety, trading at the intrinsic value. Wall Street themselves only 7% upside, and therefore for us, this 52-week low stock is not a buy, and we will give our opinion as we go along the rest of the companies today. We then move on to Kimberly Clark. Now, over the last year, it's up around 3%. Over the last 10 years, it's up only 13%, trading towards the lower end of the 52-week range. We do get a hold from every single analyst, but they do pay a fairly attractive yield of around 3.9%. In terms of their earnings, well, over the next 4 quarters, they anticipate estimate only 2 of them to be growth, with a 75% historical track record. And nonetheless, they do see growth in the earnings per share this year, and there in turn the forward P right now sits at just under the 17 mark. We do note though they get a valuation grade of a C, and this essentially telling us right now it is trading for a premium, although fairly minimally, at 8.4%. As we can see, the P on a forward non-GAAP basis is marginally higher than the comparative overall, but again will depend on which valuation metric you do use for Kimberly Clark. Now on the growth space, they get a D, not looking good year on year and forward looking, both negative. With the sector median, whilst it is positive, it is fairly small, nonetheless doing better than Kimberly Clark. And if we do take a look at the earnings per share over the longer term, expected to be around that level of the sector, 6.8 versus 7.4. Now profitability, they do come in very strong with an A+. Gross margin 36 versus 36, pretty much in line. Bottom line though, looking better at 13 versus 4. The one thing that really stands out, they do generate a lot of cash from operations, 3.6 billion versus 877 million. They do have a very safe dividend score, right now sitting at 88, and if we do look at dividend yield theory telling us a company is undervalued when the current yield sits above the 5-year, that is one signal right now, and another one with the forward P of 17 below the 5-year rolling. They're in turn telling us Kimberly Clark right now is trading at an undervaluation level. When we use our own intrinsic value, and bear in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for this stock or any others, we do have a 10% MOS at the bare minimum, something we didn't see for Estee Lauder, a buy up to $144, at 15% a buy at 136, and actually in today's episode you're getting a 20% margin of safety. Wall Street themselves, they see a price target of 147 at the end of the year, translating to 17% upside. Now, whilst it does look good in terms of the MOS at 20%, the starting yield, one thing we would say for this company, it does lack a little bit of growth, so it might be more appealing for those who are actually income investors who use the dividends for their own expenses on a day-to-day basis. As always though, do give us your thoughts in the comments below. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning for free to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 43 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. We then move on to General Mills, down 7% over the last year. Over the last 10 years, up around 7%, although we do notice all-time highs sitting around $91 mark around a year and a half, trading right now at its 52-week low. In fact, a new 52-week low for this company today. They only have one buy rating from Seeking Alpha, and we do notice the yield does now sit above the 4% mark. If we look at their earnings, only one of the next 4 they anticipate to be growth, but over the last 4, 100% track record, and with their EPS of 458 expected in May 2026, that will lower their forward P even further to just below 13. In terms of valuation, they get the B-. Right now, when we do compare it against the sector median, it is trading at a 16% discount, and that is typically what we do see for the majority of valuation metrics today for General Mills. In terms of the growth, they get a D, year on year as well as forward looking, negative, pretty much a theme we are seeing today. And if we do take a look at the EPS over the next 3 to 5 years at 2.5, significantly below the comparative at 7.4. Profitability looking better with the A-, their gross margin pretty much coming in line. Bottom line looking a lot healthier, 13 versus 4, and their cash from operations looking very good, 3.6 billion versus 877 million. They also have a very safe dividend score, which is always great to see, especially when companies start to offer yields above the 4% point. In fact, for General Mills, this is the highest dividend they've offered over the last 5 years. That is a massive, severe undervaluation signal, alongside the valuation of 13.2, pretty much the lowest it has been over the last 5 years as well. But just because these are undervaluation signals doesn't mean you should be buying them. In terms of the intrinsic value at $65, well, in today's episode for General Mills, we say a bang on 10% point. In terms of Wall Street, their upside $69 with 17% upside. Again, these stocks that we have seen today, particularly this one in Kimberly Clark, will be more attractive for those dividend income investors who do use the dividends straight away, as the growth from what we have seen is looking fairly minimal. We then move on to Archer Daniels Midland, down 26% over the last year. Over the last 10 years, up only 7%. All-time highs around the $97 mark, trading towards the 52-week lows with just a buy from Seeking Alpha. Another yield near the 4% mark, 3.91 to be exact. And if we do look at their earnings, 2 of the next 4 are expected to be positive. However, out of the last 4, they have missed 2, so a 50% track record. And they do anticipate this year, although very marginally, the earnings per share to decrease, which in turn will very marginally increase the forward PE. Valuation, they do get an A-. We can in fact see when you do compare it, you are getting a massive discount of 32%. But remember, some companies just aren't as strong as others, and it is warranted why they do trade at a discount. But this is something we can see no matter which valuation metric you do look at today. Growth looking very poor, both on a year-on-year basis where it's double-digit negative, as well as forward-looking negative 5%. As we can see, this industry is anticipated to grow even marginally still positive. And essentially the earnings per share for this company in particular, something to point out, negative 6% with a comparative at 7.4. In terms of profitability, looking better with the A, although their gross margin is very low, 7 versus 36, and their bottom line at 2% does come in lower than the comparative at 4.2. However, one thing they are very strong at is generating a lot of cash, 5 billion, significantly higher than the 877 million comparative. Dividend safety score sitting at 70, so that does look to be good. And we get that double undervaluation signal, both yield above the 5-year and the forward P well below the 5-year 13.6. So in terms of valuation for ADM, when we do get to our MOS at 10%, a buy at 53, at 15%, pretty much around where we see it now, but Wall Street themselves only see 8% upside. So again, this isn't one that we would particularly say is a buy. When we look at the last 4 that we have seen so far today, this one will be at the bottom of the pile with Estee Lauder. Kimberly Clark definitely looks like a stronger buy, as well as General Mills if we had to rank them. We then move on to Stanley Black & Decker, a dividend king, down 12% over the last year. Over the last 10 years, however, down 11%. All-time highs around $216, trading right there towards the 52-week lows with just a buy from Seeking Alpha, another company with fairly high yields of just under 4%. And what is great to see, the first one today with green right across the board. In fact, over the next 4 quarters, they are anticipating double-digit growth year on year, and we can in fact see some very strong outperformances over the last year, 100% track record, and that gives their forward P right now around the 15 mark. In terms of valuation, A-. When we do take a look at the P though, it is pretty much in line with the sector comparative, only a very small discount of 2.5%, something we do see in pretty much every valuation metric. And their growth, they do get an A, even though we can see over both the historical and forward-looking basis, it is negative. But what we do like, and clearly we can see why they got the stronger rating on growth, earnings per share expected 34% year on year over the next 3 to 5 years with a comparative at 11.5. Profitability looking good at a B, gross margin 30 versus 32, bottom line negative though, so a little bit of a worry, something to consider with the sector at 6.5. However, we do in fact note they do generate a lot of cash from operations, 1.2 billion, whereas the sector comparative comes at 342 million. Dividend safety also looks good at an 80 safe score, and we also notice this undervaluation, 3.92 above 3, 16.5 below 19.5. So when we look at the valuation itself, the intrinsic value for us coming at around $100, we can in fact see today you're getting a 15% MOS, with Wall Street themselves upside of 17%, their price target $98, and is definitely one of the more attractive ones that we have gone through today. But as always, do let us know your thoughts in the comments below. It is interesting to see whether or not you believe some of these that maybe do lack a little bit of growth but have a high yield may attract you. Some people will love this, other investors won't, but that comes down to everyone's investment thesis and strategy. And also don't forget to grab a free copy of the weekly newsletter and grab those spreadsheets. Come and join us as well in the Patreon, where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.